When you look at the stock market, it usually looks exactly like this. A wall of flashing red and green numbers, scrolling tickers, and jargon. But beneath all that noise is a system built to solve one specific, very human problem: finding a way to let your money grow while you sleep. To understand how it actually works, we can look at a much smaller scale. Imagine a local business owner. Let's call him Sharma Uncle. He runs a small, dusty shop selling pens. He wants to build a nationwide pen empire, but when he opens his cash box, he barely has enough to pay his electric bill. Uncle needs capital to expand, so he walks up to 3 of his neighbors and makes them an offer. If they give him their unused savings to build new shops, he will give them a permanent fractional piece of his business in return. By trading their cash for a slice of the future, these neighbors have entered the same ownership model used by the world's largest corporations to scale their ideas. This solid box represents Uncle's entire business, the stock. To sell pieces, he slices it into identical blocks called shares. If one neighbor buys a single share and another buys 5, the second holds 5 times the weight, receiving 5 times the profit. Uncle takes their combined investment, hires staff, and successfully opens 3 new locations. The pen business begins generating more revenue than it costs to run. And because those neighbors are now partial owners, they automatically get a cut of that new money. That regular payout of company profits to the shareholders is called a dividend. It is the literal mechanism of getting paid without doing a single hour of the physical labor. This concept is straightforward. Complexity only arrives when you try to do this on a global scale. As we zoom out from the local neighborhood, we arrive here. The stock market is the world's largest bazaar, designed for trading fractional ownership. But instead of 3 neighbors quietly shaking hands over a counter, this bazaar consists of millions of people executing buy and sell orders simultaneously. This sheer volume of activity creates a strange disconnect. The physical pen shop might sell the exact same number of pens on a Tuesday as it did on a Monday, yet the price of its shares will fluctuate minute by minute. This scale shows exactly why. The daily ticker price is driven by supply and demand, and that demand isn't based on what the company is worth today. It's driven by public belief about the future. If rumors of a scandal break, public belief shifts instantly. Shareholders panic, the supply outweighs the demand, and the price crashes. A stock's ticker price functions as a real-time mathematical measurement of millions of individual people making educated guesses about the future. Those guesses vary depending on the type of business. Massive, stable, decades-old companies are known as blue chips because they grow slowly and reliably. On the opposite end are penny stocks, unproven startups that could explode or disappear in months. When you aggregate the belief of investors across the entire ecosystem, economic trends start to emerge. When collective optimism is high and prices rise across the board, it is a bull market. The term actually comes from the specific way a bull attacks its target, by thrusting its heavy horns sharply upward. Conversely, a period of widespread pessimism and falling prices is called a bear market, named for how a bear attacks by swiping its paws downward. Your success as an investor relies on navigating these emotional, market-wide swings without letting a single bad guess wipe out your savings. The math of investing in a single company is punishing. If you put all your money into one specific pen brand and that brand fails, you lose absolutely everything. To neutralize that chaos, everyday investors rely on a systemic solution known as a fund. This screen displays the most famous example in the world, the S&P 500. Instead of buying a piece of one business, a fund bundles together tiny pieces of the 500 largest companies in America, spanning tech, healthcare, and banking. This grid demonstrates the protective math of diversification. If 1 or 2 companies in the bundle completely collapse, the steady, continued growth of the other 499 companies absorbs the blow and keeps your overall investment standing. There are other structures, like hedge funds, which use complex betting strategies, but those carry a high risk of failure and are legally restricted to wealthy insiders and accredited VIPs. For everyone else, index funds transform the stock market from a high-stakes casino into a reliable utility. They allow regular people to own the means of production, patiently building wealth alongside the most successful businesses on Earth.